Owning the 500 stocks within the S&P 500 is great. Warren Buffett says it's like buying a piece of America. Of course, we're talking about the 500 largest U.S. publicly traded companies. I'm Kenny Robinson, and in this video, I want to show you how to gain access to the 53 top performing stocks of the S&P 500. That means you're able to invest solely in those 53 stocks rather than gaining exposure to the entire index. Now, these 53 stocks have over the long term outperformed the S&P 500 by simply minimizing losses. Now, we'll hop on my computer and I'll show you exactly how they do that. Let's get started. All right, and just like that, we're at my computer. Hopefully you can see my screen. So let's start out with the top 53 Dividend Aristocrats, and these are the outperformers that I mentioned just a second ago. So what is a Dividend Aristocrat? Well, the Dividend Aristocrats are a select group of 53 S&P 500 stocks with 25 plus years of consecutive dividend increases. This means at this point in time, even in 2008, when the global economy was in the dumps, these stocks continued to not only pay their dividend, but they also increased their dividend that year in 2008 and every year thereafter. Now, like I said, they are the best of the best in dividend growth stocks. And they also have a long history of outperforming the market in general, which we'll get to in a little bit. But here are the requirements to become a Dividend Aristocrat. You have to be a component of the S&P 500. You have to have, like I said, 25 plus years of consecutive dividend increases. That means if you miss a year, you're kicked off of the list. And you also have to meet certain minimum size and liquidity requirements, but that's less mentioned here. Most of the time when people think of consecutive years of dividend increases, they think of the Dividend Aristocrats and that magic number of 25 years. So, like I said, there are currently 53 Dividend Aristocrats at the time of this video. Now, all Dividend Aristocrats are generally high quality businesses based on their long dividend histories, right? You can say, okay, if they have continued cash flow, they must be doing something right. So, a company cannot continue to pay and raise dividends for 25 years and ongoing without really having a strong, durable, and stable competitive advantage, right? And again, these are companies and businesses that both have the desire and ability to pay shareholders rising dividends year after year. And this is a rare combination. And what I really mean by that is, a lot of companies may want to pay their shareholders consistent dividends and consistently raise them. They just don't have the ability to. And on the flip side, some companies have the ability to do that. They just don't do that. They don't have the desire to do that. So again, these are businesses that both have the desire and the ability to pay and raise their dividends year after year. As mentioned before, the Dividend Aristocrats Index has outperformed the market by a wide margin just over the last decade, and they've done that with lower volatility. So let me say that again. Listen closely. Not only has the Dividend Aristocrats Index outperformed the S&P, but they've done so with lower volatility. And what that means for newer investors is you've earned more money over the past decade, and you've done so with less up and down movement within the price within your account balance. So this chart shows going back to 08 all the way up to we're into 2018. The dark line is the S&P 500. Okay, the 500 largest U.S. publicly traded companies. Okay, like buying a piece of America. The light blue line is the Dividend Aristocrats, 53 companies with 25 plus years of dividend increases. Here we go. Look at that consistent outperformance. Now, the Dividend Aristocrats Index annualized risk-adjusted returns are far in excess. As you can see here, look at the widening gap there, okay? And total returns with lower volatility is essentially the holy grail of investing, just like we hit on a second ago, okay? A significant portion of the outperformance relative to the S&P 500 comes during the recessions, the tech bubble, right, 2000 to 2002, and the credit crunch or the financial crisis of 08, the housing market crash, right? Dividend Aristocrats have historically seen smaller drawdowns during recessions versus the S&P 500. Okay, so let's go back to 08, right? So there's the, again, the dark blue, right? You can see that's lower than the top light blue line, which is the Dividend Aristocrats Index. And this makes holding through recessions that much easier. So if you're a long-term investor, it's really nice to see lower volatility and higher returns. So for example, in 2008, the Dividend Aristocrats declined by only 22%, which still, that's a big hit, don't get me wrong, although relative to the S&P, it was almost half of what the S&P did, going down in the hole in 2008. So here's that with the numbers spread out. And on this axis, we have the years. This axis, we have the returns. So over here in this column, we have the Dividend Aristocrats, we have the S&P, and then we have the difference, right? And so if you look at the downturns, like here's the tech bubble, 2002, those 3 years, where the S&P 500 in general did horribly. It was actually negative, where the first 2 years of the tech crunch, this actually, the Dividend Aristocrats actually gained double digits, right? It's not a very tech-heavy index, I'll give it that much. And then in 2002, they're not bulletproof, but of course, they actually had less than half the volatility of the overall broader markets and beating it by 12.2%. Let's look at 2008. Here we go, negative, let's just call it 22. And 37% respectively, which says it outperformed it by about 15%. So so from 91 to 2017, the Dividend Aristocrats have averaged about 12.9% annualized total return, whereas the S&P has done about 10.7, which means the Dividend Aristocrats outperform it just by over about 2%. So how did they do that? So here's the real way to win in the market. You know, a lot of people talk about, oh, you know, I've had this much of a gain in my portfolio, or I can get this much of a gain, or I've done this much. Well, the best question to ask those people is, okay, well, what was your portfolio doing in 2008? How do you manage your losses, right? Because the biggest problem is, you know, if you have a 40% loss in your portfolio or a drawdown like in 2008, you have to earn 67% just to get back to where you were, right? And so you have to keep in mind, if you lose 50% of your portfolio, you have to gain 100% just to get back to where you were, right? It's not a one-for-one. If you lose 50% and you gain 50%, you're still in the hole. And so that's where the Dividend Aristocrats really gain ground, right? So on good years, you know, with Amazon and all the other tech companies and internet e-commerce companies, yeah, it'll outperform the Dividend Aristocrats. But in the down years, that's really where your portfolio is able to hold its ground because it doesn't go as deep into the hole. And so that's really, you know, what this talks about is, you know, never lose money. And that's actually, if you've studied Warren Buffett at all, he says, you know, the number one rule is, you know, don't lose money. And the second rule is, you know, never break rule number one. So never lose money. And this is really the impacts of losses. And you can see this by going to Crestmont Research. And these charts right here were sourced from SureDividend.com. So as we go through this, keep in mind, you know, you really want to minimize the impact of losses on your portfolio, and the S&P 500 Dividend Aristocrats can do that for you. So with great businesses with strong competitive advantages, they tend to be able to generate stronger cash flows during recessions. That's how they do it, right? This allows them to gain market share while weaker businesses fight to stay alive, right? So in 2008, companies are fighting just to tread water, right, to not sink, whereas when you have a company with a very strong balance sheet and a proven business model, they're able to steal market share during those recessions, okay? So the dividend-paying stocks outperform non-dividend paying stocks for several reasons, right? A company that pays dividends is likely to be generating earnings or cash flows so that it can actually pay dividends to shareholders, right? So most companies, I'm not going to say all, but most companies that pay a dividend obviously are making money and they have good cash flow. And so inherently, when you invest in the Dividend Aristocrats, this excludes, keep in mind, excludes pre-earning startups and failing businesses and speculative type investments that can hurt your overall performance. So in short, the Dividend Aristocrats really excludes the riskiest stocks, right? Number two, a business that pays consistent dividends must be more selective with the growth projects that it takes on, because a portion of its cash flows are being paid out as dividends, right? They have to maintain that coveted dividend status. So scrutinizing over capital allocation decisions likely adds to shareholder value, right? They're very careful with their money. Number three, Stocks that pay dividends are willing to reward shareholders with cash payments. This is a sign that management is shareholder friendly, right? They have the big picture in the back of their heads, and they're always looking out for the shareholders, which all companies should. All publicly traded companies really should do that. Right now, you see a lot of what Tesla's talking about, going private, right? It's what's best for the company. So we'll see what happens there. If you have any input on that, drop it in the comments below. I'd love to see what everyone's thinking about Tesla going private. Anyway, so let's get back to the Dividend Aristocrats. It's believed that Dividend Aristocrats have historically outperformed the market and other dividend-paying stocks because they are, on average, higher quality businesses, right? If you can continually increase your payout to shareholders for 25 consecutive years and ongoing, that says something about your business model. Now, there's nothing magical about the Dividend Aristocrats, right? They're just a collection of high-quality, shareholder-friendly businesses that have strong competitive advantages, right? And here's a quote from Warren Buffett: "When we own portions of outstanding businesses with outstanding managements, our favorite holding period is forever." And, you know, if you've seen my other videos, I don't trade a lot of stocks. I tend to buy and hold, and I just love dividends and cash flow, so I can say I'm a dividend investor for sure. So with that, what are the 53 companies and how can you invest in it? So let's go over to the S&P 500 Dividend Aristocrats. This is here on Wikipedia. And as you can tell, now you can choose these companies yourself, but keep in mind, these companies also hop on and fall off the list, right? If they have a rough year, they fall off the list. So here's the list, here's the ticker symbols, here's the companies. A lot of these are going to be familiar because, again, they all have to be in the S&P 500. The Clorox Company, Coca-Cola, Chevron, Brown-Forman, all of these are companies you know, Abbott, of course, 3M, Aflac. As we go down the list, again, these are all companies that I'm sure you've heard of. Johnson & Johnson, that's an easy one, of course. One of my favorites is, where's it at? McDonald's. McDonald's was the very first company I worked at. I got hired there at 14 and a half. I actually did a video on that. I own their stock today, and I don't think I'll ever sell it. So that being said, of course, you can own all of these stocks individually and just do it yourself if you don't want to pay the 35 basis point ETF fee. But what's nice about owning the ETF, which is NOBL, Noble is the ticker for the S&P 500 Dividend Aristocrats ETF. The nice part about that is you don't have to worry about which ones are falling off, which ones are coming on. You always will own the best dividend payers, and you don't have to worry about rebalancing or anything like that. And for that, you know, you pay 35 basis points. To me, that's worth it, knowing that I'll always have access to the S&P 500 Dividend Aristocrats. Now, that looks like this. It's called the NOBL S&P 500 Dividend Aristocrats ETF. You can check it out. It's by ProShares. I'm not in any way, shape, or form affiliated with them. I am long Noble. I do own it. I think I'll own it forever. And if something else comes along with Dividend Aristocrats, I'll probably buy that too. So with that being said, the charts and everything came from this website here, Shore Dividend. I just want to make sure that I cite all of my sources and everything like that. And if you have any questions or comments or anything like that, drop it in the comment section below. I love to, you know, network with other investors or people who are curious about cash flow companies and Dividend Aristocrats. So with that being said, I hope you enjoyed this video. If you'd like to see something specific in the future, let me know. I'd love the feedback. And if you enjoyed this video, give it a thumbs up. It really helps me out with my YouTube channel in general. I'm definitely trying to grow it. So I invite you to subscribe and join the community. That's all I have for you in this video. Thank you for watching. We'll see you next time.